Welcome to Chit Chat Stocks. This is our weekly Power Hour episode. I am one of your hosts, Ryan Henderson, and I am joined, as always, by the one and only Brett Schaefer. And on these episodes, we talk all things financial markets. We do these live once a week on Wednesdays at 10:30 a.m. Pacific time, 1:30 p.m. Eastern time. And if you want to get any questions in, you can go on over to YouTube, look up Chit Chat Stocks, and you'll be able to see our live videos. And you can also just send them to us throughout the week, and we'll try to touch on those as well. We got plenty of topics this week. Markets in turmoil, maybe? Is
I
it?
don't think so. I think you might just be looking at Google or Alphabet's stock price. Alphabet, apparently, they've been winning in AI, they've been losing in AI, they've been winning in AI. Now maybe they're losing again, according to Mr. Market. Lots of volatility with that stock, and I think another fun update for them could be fun to discuss. Maybe a spoiler alert. I have no idea why the stock is down, but it's in a 20% drawdown. And hey, if you like the company, could be a buying opportunity.
Banks, Brett. Recession fears are looming. There now, we joke around about recession here, recession there, because it seems like people are concerned about it 24/7. There was some concerning language that came out of a specific conference call that sent pretty much the entire banking sector down for the day. And I'll talk about what that is in a sec. Brett's also got a couple other topics here as well. So we're going to be talking Google iPhone event. The Apple event was out as well. And then I've got 7 industry leaders that just hit 52-week lows. So that one should be, some of these are pretty interesting. I'll just little tease here. And I know there's one company that you've been interested in the past. So we'll definitely get to that as well. But before we get to the show, we want to talk about our friends at Public. If you want to earn a 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part, if you act now, you can potentially lock in a 6.9% yield until 2028. In other words, no need to worry about the Fed's upcoming rate cuts. With a bond account at public.com, you can earn a 6.9% yield even as rates fall. It only takes a couple of minutes to get started, but you have to act fast if you want to take advantage of some of the highest bond yields in years. Discover how you can lock in a 6.9% yield until 2028 with the new bond account only at public.com/chit chat stocks. With that said, Brett, where do you want to kick things off?
Let's do recession back on. Recession's been off. Recession's been on, I think, ever since 2022. Do you remember when the conference calls in 2022 when every CEO, when they had a bad quarter, just said, well, I mean, these economists have said that we're heading into a recession, and then it never happened and their businesses just weren't that good? Well, maybe you have some info for us that there is some actual slowdown within consumer spending, consumer paybacks on loans. What has you concerned, Ryan, our macroeconomist at Chit Chat Stocks?
Yeah, this I am the chief Chit Chat Stocks economist. No, last week we said something along the lines of what one of our listeners in the comments said, are we concerned at all about some of the reports coming out from consumer discretionary type businesses? And I basically said, no, I don't think less people going to Starbucks is a bad sign for the economy. However, I'm starting to maybe eat my words here because I'm wondering if that is maybe a leading indicator and it's not just less people going to Starbucks. That's not the issue, but a lot of these discretionary businesses or not discretionary businesses, but the retailers, Lululemon, Nike, Starbucks, McDonald's, stuff like that, as well as discretionary items at the grocery stores. We're seeing this with most of the retailers, the big retailers in the U.S. reporting weak numbers. So I at first I glanced it off. Now this week we have Ally Financial's CFO coming onto one of the sell side conferences, and he came out and said, in July and August, we saw delinquencies up about 20 basis points versus our expectations, and we saw net charge-offs up about 10 basis points versus our expectations. goes on to say, we are clearly dealing with a cohort of borrowers who have been struggling with cost of living and now are struggling with an employment picture that's worse than unemployment. I think that maybe got misquoted here. That's worse. Unemployment is up approximately 50 basis points since the beginning of the year. Basically, for context here, Ally Financial is one of the largest used car lenders in America. Automotive loans in general tend to have some of the lowest delinquency rates among lending categories. It's one of the first things people pay back because, if you need, it's something you don't want to default on because you really need your car, right? You need your car to get to work, to make money, to afford all your other loans. So a bunch of banks sold off on this. JP Morgan, I think, was actually down 7% on the day. Obviously,
I think that might have been because of an update on the Basel III Endgame, which is the most hilarious name for banking regulations. That might have been it for JP Morgan, but for Ally, it was down around 20%, right? I got to say, 10 basis points, 20 basis points increases from their models, which weren't that aggressive for what they were expecting for losses. Did that deserve a 20% drawdown? I'm not so sure. But
yeah,
clearly not great. You'd obviously want it to move in the opposite direction if possible.
Yeah, and I think they're still trending above historical delinquency rates, like pre-COVID delinquency rates. So it's, I'll check on that in a second. But I guess the commentary was somewhat concerning. So, I mean, it's not like some niche case where they're lending to something really specific. It's a lot of Americans that are, have Ally automotive loans. So maybe, I don't know, is this more concerning to you to now see discretionary spending pulling in a bit and now delinquency rates starting to tick up? Is that have any sort of, do you feel like there's maybe a little more concern than we should have from a macro standpoint?
I would say if that impacted my investing decisions, yes. But given I have a long time horizon and I'm young, I don't have to worry about something like this. I have to worry about bond allocations. It's not concerning for me personally, but clearly Ally is a good barometer on consumer health. And if their charge-offs and what was it, delinquencies, if they're going up, that means a higher percentage of their borrowers are getting desperate, and that's not a good thing. But who knows, though, whether this is going to revert back in 2 quarters. I think 2 months don't make a trend. We've seen stuff, even think about inflation came out today. No one cares about it anymore because it's gonna get back down to 2%. It's about 3% maybe, or it's in between 2 and 3%. Remember when there's some months when it was slightly higher than expected, some months it's slightly lower. Now it's been multiple quarters, so I think probably 5 or 6 quarters where we've seen it move generally in the right direction, and we've seen hourly wages growing faster than inflation for that same time period now. And if that happens with Ally, I'd call it a trend, and it'd be something that's clearly concerning. Now, if you're going to make a short-term bet on a portfolio, yeah, maybe, hey, this is a big red flag. But does this mean Ally's business is in shambles? No.
I agree. It's definitely not the direction, as an Ally shareholder, it's not the direction I wanted things to head.
So what chart are you showing here?
This here is the net charge off, the quarterly net charge off rates. So you can see kind of pre-COVID, it was slightly lower than what it is today, or what it was last quarter. So it's slightly above where they were. And they just said it's starting to tick up again. So yeah, net interest margins are likely going to compress. That's why Ally stock sold off on the news. But I don't know how far out I would extrapolate this. I wouldn't be all the banks. The one thing I do find funny is if one bank goes to a sell side conference and they say a couple concerning things about their cohort,
10 basis points, Ryan.
If they say anything about the cohort they're lending to, it seems like a lot of people extrapolate it to every single company with credit risk. We saw this with the collapse of Silicon Valley Bank and First Republic, where it's like, oh, if you have any credit risk, this is danger time.
Or any treasuries on your balance sheet or any mortgages on your balance sheet, it's over. Now, there was some that were actually you should be concerned about, like Charles Schwab, and it's been a headwind for them for a long time. And given the mistakes they made with that balance sheet, it's going to be a headwind with them for years. But most of the banks, it wasn't a huge concern. We have a question here in the comments says, what banks do you guys think would have the lowest losses if we get a small recession or credit losses ramp a little? It might be interesting to hunt for the banks, which are the quote, baby with the bathwater. First one I said was American Express, although I usually like to push back on that, even though I'm using them as an example, because people talk about how American Express deserves a lower multiple versus Visa and MasterCard, and maybe they do. But the reason they give, I think, is wrong because they say, well, Visa and MasterCard don't take credit risk. But over half of American Express's business comes from the same thing that Visa and MasterCard make, which is how they make money, which is the payment fees. And then another huge chunk are the credit card annual fees for the high, premium cards. That's not credit risk. A small part of their business is credit risk. And will they be affected? Yes. If their losses go up, yeah, they'll be affected. And I think they would probably be more insulated in a recession. Maybe back in the day, I would have said First Republic because they cater to wealthier clients. They supposedly had a good culture, but I'm not so sure. I don't follow the sector that closely. So you have any ideas, Ryan?
People with student loans or companies with student loans, because it's something that's hard to default on, and it's guaranteed. A lot of it's guaranteed by the government. So, know that. I know I'm talking my book here, but if you are a lender to the student loan category, which it's kind of legacy companies at this point because they aren't able to actively do so as much anymore, I think you're probably insulated from any sort of credit pressure. But that's kind of a small cohort of banks. So, I think if you're catering to the highest, most affluent customers, you're probably fine. I would be curious who has performed better, American Express or Visa and MasterCard over the last, let's do 5 years.
5 years, it's definitely American Express.
Yeah, here I'm just.
I think I checked this like last week, so that's not some great memory thing by me. But let's maybe as you're checking that, we can talk another topic here, and that's Google. We even had a question here on Twitter. I'll read it out. What do you two think is the best bear case for Google, and what are your thoughts on why people are selling Google? The bear case, I think, is pretty clear, and that's good if you're a shareholder because you can understand why people are bearish to the company. And I think it's because they believe market share is going to be disrupted. And the dominant 80% plus on desktop, 95% plus on mobile, all that stuff is going to get disrupted. But Ryan, maybe an update before we go. American Express or Visa?
5 years, American Express. 10 years, Visa and MasterCard have crushed American Express. But I guess at this point, it's not that bad of a starting base for Visa and MasterCard. It's not like they were unheard of 10 years ago. So I know when they came public in what, like
I think
early
the 2000s, yeah. It was like 04 maybe was Visa.
Really?
One of the biggest IPOs ever, yeah.
What about MasterCard? Do you remember?
Don't know. Do not know.
Anyways, yeah, so American Express has outperformed over the last 5 years. Regards to Google, let's go through some of the numbers. I don't know if I'm really that tempted. The one thing I will say, I don't buy the hype that Google's core cash flow machine, and well, I guess they have a couple of those now, Google search is in decline. I don't buy it. And I'm still yet to see any credible. I'm yet to see anything that has really proven otherwise.
Yeah.
Would you agree?
I agree. I agree. So you're saying, I mean, can you repeat that? What are you trying to say?
If people are concerned that Google is going to lose share on desktop, I just don't buy it, and I'm yet to see anything that's really indicated that they are losing share. Maybe like the tiny, I think you've shown that chart before where it's like Google's market share on desktop, and it's like the slightest decline.
Yeah, and there's some estimates out there. I saw a chart that showed them moving in the wrong direction and Bing picking up some share, but a lot of people say that it's hard to trust those fully. So I'm not exactly sure on that. I mean, even with that one that showed them losing a little bit of market share, they were still at 80%. I would say that Microsoft is investing tens of billions of dollars in both OpenAI and their internal investments. And then also within desktop has a lot of cases for Windows users to have a competitive advantage to make the Edge browser, which for people that don't know, because it's not very popular, making it the default browser. And within that, they make Bing the default search engine. Even with that, Google still has 80% share. I think people may be concerned that that could fall a bit, but remember that mobile is more important and more important every year. I think the actual concern, and it's the obvious one, it's the AI threat. It's the 100 AI startups, not just OpenAI, trying to attack Google finally after 10 years of never getting attacked. And maybe people are worried about an AI slowdown and not much innovation coming out the last few quarters. I don't know. Maybe it's because Sergey Brin was the special guest at the All In Summit. People got spooked by that. You missed it, Ryan.
Were you spooked by that?
I did not see anything except that he was going to be a special guest. And I think tickets cost closer to $10,000 than $1,000 for that. So not a bad business they got running over there.
No,
Not bad at all.
I agree. So I'm looking EV to EBIT here for Google Alphabet, excuse me, 17.4. That's actually, let's go forward EV to EBIT here. Obviously, consensus could be wrong, but forward EV to EBIT 15.3. Okay, I was wrong. I might be interested in this. I think Google, a couple quotes that stood out to me. I heard a quote one time that said, if Google doesn't have a moat, no digital company does. And I think that's true. I think they have as solid of a digital moat as you can find. Maybe Visa as well. Other quote that stood out to me was Apple's, was it the VP of devices or something like that? The VP of services that in the court filings for the antitrust stuff said there's no price Bing could have paid. There's no price Microsoft could have paid to become our default browser.
Yeah, the product wasn't very good. It's not gonna. They don't have the revenue. They don't have the backbone. It's not just about the search results. Even it's about the advertising backbone as part of that. Because when you're doing revenue share, well, you'd like your partner to make as much money as possible because then you make more money. Yeah, it's tough. And what's interesting is that Microsoft may be in a standoff that hurts both them and Alphabet if they take market share, because they're going to have to spend. I mean, the OpenAI round is coming. Like, they're going to need billions and tens of billions of more dollars, and someone's going to have to give it to them. Microsoft seems like the most likely candidate, although I think they're being hesitant because they're investing in a lot more startups now and acquiring a lot more AI talent that's not in the OpenAI ecosystem. But if you look at internal plus OpenAI investments plus the acquisitions, Microsoft is going to have to spend definitely over $100 billion. And if they take a little market share from Alphabet, well, the ROIC is going to be quite negative. And Alphabet might just lose some revenue. So it'd be a lose-lose situation, except for maybe it all just goes to NVIDIA.
Yeah, bull case for NVIDIA there.
It's just a crapshoot. I don't, right? How many variables? Who knows? Who knows?
Yeah. Yeah, I agree. It's so difficult to tell because on the one hand, I think I'm not really changing my habits all that much in terms of like how I search things. I don't use that many. I mean, FinChat is where I work. It's powered, the Copilot is powered by OpenAI, and I still use that frequently, but I think it might be complementary. It's not like I'm like taking what I would have searched on Google and putting it into FinChat. Like it's just kind of different. So it's like,
It's more for more detailed research things, and it's more
yeah,
for specialized niches. I get that. Where what I come back to is what disrupts the vacations or hotels in Cancun. That I don't think
well,
there's
Booking's
ways to.
building an AI.
Yeah, I don't know if there's ways to improve on that from a full blown like we're changing. And there's ways to optimize it, but I don't know if that needs much improvement, and that's where the cash cow comes from. Not what was Microsoft's return on invested capital in 1997.
Yeah. Yeah. I agree.
Well, okay, EV to EBIT. I know it's just a number, and trailing doesn't matter, and it's all about the future cash flows. But gut check, what EV to EBIT? We're at 17.5 right now.
Yeah.
What EV to EBIT are you saying Alphabet belongs in my portfolio?
I should probably just own some now, to be honest. Because every quarter, I remember in like 2018, we had this discussion with Nick Seipel, I think. And it was like, we're like, basically, why don't we own big tech? It's like, it's so, and basically our conclusion was it's more or less, it's too mainstream. It's, trees can't grow to the sky. Like at some point, they're going to run out of room to grow, and it's just not materialized at all. And every single quarter, it seems like it'd be so fun to just own big tech. Honestly, like you could, like the conference calls are just like celebrations of how many people use their products and how much
Yeah,
people are willing to pay.
yeah, got a comment here that says nobody looks smart owning big tech, but they sure do get rich. Yeah. And I think there's some hesitancy from people about being worried about being the last person at the table. And I think that's probably a bias you got to try to get out of your head. I would say given the risks with Google because of all the competition attacking them, and now I'm pretty confident that they'll retain their moat. But again, it is a moat attack. I think I like it at 17 times earnings, but I
Yeah,
don't love it. I love it closer to 13.
sure. Yeah, I mean, I think we've done this dance before where it's like, I like it at 15, I like it at 17, but I'd like it a lot more at, 10. And the further you go down you go, the more you'd like it. I think what scared us off initially, if I remember correctly, was we saw those tables of the top stocks by market cap by decade. And if you go back and you look at like the 70s, the 80s, the 90s, it was never the top ones didn't stick. But now for 2 decades in a row, it's been relatively close, relatively similar. I don't know. I wouldn't say 3 decades.
I think Microsoft and Apple maybe, but probably just them.
Yeah, so I get that I don't want to say it's different this time, but I think these businesses are so high quality, have so many levers to pull in order to grow, and we're about to talk about one, which little spoiler alert, Waymo. It's these. I think they are much, much higher quality than the IBMs of the 70s or whatever the top stock was then. Sears, I guess.
Maybe.
Could be
Sears
wrong.
definitely had a moat though in that day, but the internet disrupted it. And
So
they
is
probably mismanaged.
OpenAI the internet in this case?
I don't know. I what I do know is that Alphabet is not a company that is riskless. I think it has a wide moat, but I don't think it's riskless. And I would like especially hearing these quotes about how Sundar Pichai said, I'm not worried about returns. I'm worried about I'm worried about underinvesting. I want to spend as much as possible. And the anecdotes, people saying that Larry Page and Sergey Brin would rather spend all of Google's money and to win in AI versus lose and underspend. I just don't know if this is the best time to be buying, but
Yeah, I don't. But hey, Zuckerberg was saying the same stuff at the
right, a lot of
absolute bottom,
narrative.
right? Like, we're gonna invest, we're gonna invest, we're gonna invest. Here's what I do know. I know I spend a ridiculous amount of my time on YouTube and Google products every single day. I know that
Yep.
cloud GCP is turning into quite a wonderful business from the looks of it. It's it feels like I'd be kicking myself for not buying this at 15 times forward earnings.
Yeah. Remember, Meta though was trading at about 6 times forward earnings though. It's a little
Not the
different.
same thing. Not the same thing at all. I agree. It like not the same opportunity here, but I think you can get better than a market return. 'Cause I don't see multiple compression as a big risk at 15 times forward earnings for Google.
Yeah, and they got
And
the buyback machine pretty consistent, so now that can be even more attractive. Probably reduce share count by about 3-4% a year at this rate, if they decide to. I guess they have the dividend now, but all right, that's enough on that topic.
let's give an
Ah,
update on Waymo. I want to hear about this.
Oh, okay. This was a JP Morgan report. I will pull her up. Spoiler alert, they said they were bullish and they made some very precise measurements. It's essentially the question is Waymo finally inflecting. Here is something. Oh, excuse me. It was from Morgan Stanley. Maybe I didn't say Morgan Stanley. Either way, investment bankers putting out some memos. Here's what they say. Too long, don't read. Waymo is a real business worth modeling. Uber and Lyft are quickly losing share, so they better partner up. And they have these summaries. Let me just zoom in so I can read it. Key takeaways. While we think broad autonomous vehicle solutions are still multiple years away, Waymo data release offers look into autonomous path ahead as we introduce city by city Waymo model. That's got to be fun to model city by city for that investment bankers. It's a lot of trips to the $25 Chipotle in
Are they just
Manhattan.
are they just going like, here's the population, here's the percent that
I
could
think
take a
they give some
Waymo?
good data, but who knows? Waymo is seeing a 10x increase in weekly trips versus May of last year, while geographic and use case expansion opportunities support continued growth across all markets. We estimate, here's the key one I saw, we estimate that Waymo can make up a low to mid single digit percentage share of the Phoenix and San Francisco rideshare markets by 2025. Waymo pace of expansion accelerating in other cities. So the thought is here in some of these big cities that Waymo has begun in, it's going to become, and it has become, a decent percent of the market where if they grow at the same rate or even slow it out a bit by 2025, Uber and Lyft will be impacted in those cities. Now, it's only a few cities, but that's got to be a concern. I think for me, it puts Uber for me in the too hard pile right now. I need to see what this industry will look like post. I would rather buy Uber if they get through this because then there's not going to be another thing on top of autonomous vehicles, right?
Yeah.
Then the industry is solved. And if they retain their share and their network effect and whatever all the moat stuff that people talk about, then I'd be interested in. But right now, there's just such a huge disruption risk. That's my take. What's your take? I'll let
I,
you talk.
I think it's hard, at least for me and probably for a lot of other investors, to think about Waymo as anything other than theoretical. But in these cities, like in a number of the cities, it's here. Like, they are giving rides. It's a revenue generating business. Like, it's working. I have all the optimism in the world that I think Waymo can work, and I think it could be a very profitable business for them, and certainly disrupt. It's hard for me to see how this is not a clear disruption to Uber and Lyft, assuming that Google decides to undercut them on costs, which they certainly could if they don't have drivers, right? Like, that's the biggest cost, and it's out of the whatever P&L, I guess. It's no longer a part of how their business works. That's a huge problem. And at worst, maybe Uber and Lyft license the technology or something. They become a customer in some way in certain cities. But here, I think it's going to work. I think it's going to be a really profitable business for them. I think Uber and Lyft will have difficulties in the cities where they operate. What is your over under on when Waymo gets split out in the financials? If it's, let's go 2028, over or under?
Under.
Really?
Because I think, well, there's a lot. I know I like to say this, but there's a lot of variables because of antitrust, and we could see. I could love if they start gaining a lot of market share, and then later on we have to stock big robo taxi. Classic stuff. But I think there's a
Like,
runway there for them to be profitable, and they would still have. I think they probably still use TPUs. They probably still use a lot of the Alphabet tech, and they probably are still run on the Google Cloud. So that would be the same. You could just have, toss them $10-20 billion and let them operate on their own. It'd probably be better for them too, because then you're not caught up in all the bureaucracy of Alphabet, which you got 200,000 employees. It's got to slow you down.
yeah, the difficulty here is that it doesn't I guess I'm not an engineer, and I'm certainly don't understand the technology that's going on here, but I imagine it's not like, okay, you've solved it, it scales everywhere. It's probably slower because they're taking this city by city approach, and each city
Yeah,
has like nuances. So it's not like the growth is going to be, I imagine it's not going to be like exponential. Like it's going to be probably a little more. I mean, obviously it'll still grow fast if it's having a big impact in these cities, but uh, maybe it doesn't get split out quite as early. I'd say they're going to try to hold out splitting it off as long as they possibly can.
yeah. I guess 2028 is not as far as people think. We have a comment here that says, have heard some quality thinking about end state of Waymo and Uber, hybrid fixed capacity of Waymo and flex capacity of Uber with driver, revenue share with rides hailed through unified app, etc. Yeah, I guess Waymo does have fixed capacity because they can't just onboard a bunch of these. There's some fixed cost to getting these uploaded. You can't have a lot of inventory just sitting there. I think, yes, you're right that it doesn't just scale to another city right away, but within the city. So right now, let's say they've geo-fenced and can operate fully in all of Phoenix. Well, when you're at say 5% market share, it doesn't take the variable costs of going from 5% to 20% market share are not as high as that first 5%. And you already have the fixed costs, which would be one, your software development. Those AI engineers are expensive. Two, a lot of the upfront cloud training costs. And three, the upfront costs for, which I think are a very expensive part of autonomous vehicles from what I've read, is the sensors and all the stuff that sit on the vehicle.
Yeah, so who's the picks and shovel provider here? Once again, NVIDIA.
Yeah, or Google Cloud. Yeah, it's nice to have such vertical integration if you're Alphabet, I would say. And the TPUs that they invested in 10 years ago. Once again, they have been ahead of the pack, and that's why I think, man, should I just buy them? They've always shown their culture has been we're way ahead of the game on technological stuff, and they are the ones snapping up every single AI engineer 10 years ago.
Okay, real quick before we get to the rest of the topics for the show, if you want to earn a 6.9% yield for the next 4 years or more, you need to check out the bond account at public.com. It's a new way to invest in a diversified portfolio of bonds and receive monthly interest payments. The best part, if you act now, you can potentially lock in a 6.9% yield until 2028. That is the new bond account only at public.com/Chit Chat Stocks. Go ahead, check it out. It is a really cool product, so highly recommend it.
And the Fed's about to lower interest rates. That high yield savings account, 4.5%. That's going to drop to 3.5% if they do. With Public, if you're looking for fixed income, they can lock you in, and it's pretty innovative product. I got to say, I checked out some of the details. But Ryan, I know you're going to do some of your listicle stuff that people love and your small cap of the week. But I got to ask first: are you buying the AI iPhone?
So I actually have no idea what this is. You putting it in into the notes here. Is the first time I'm seeing this.
Did you not know there was an iPhone event this week?
I mean, I saw it, but I don't know if I'm the only one, but I just simply do not care at all. Like I never watched one of these. I don't get intrigued by them. Like maybe back in the day when it was a very new product, even with the VR, I was a little more interested with that, the goggles, but just like 12th iterations or 15th iterations on the same product, it doesn't really draw my attention.
What if I told you it comes in pink or rose gold?
Okay, well now you've got my attention.
Honestly, people make fun of that. I make fun of that, but hey, women love it, so that's gonna drive some of your.
What is the AI iPhone? I did hear they mentioned Apple Intelligence a number of times.
Yeah, exactly. They're just gonna have some sort of Apple Intelligence. What's interesting is I think it's powered by OpenAI, and I don't want my data shared with OpenAI, but that's a topic for another time. This was another interesting chart, though, Ryan. Kind of confirms, I'm sure the people that have access to all these data and third-party intelligence and banking reports knew this, and people talk about this all the time. It's a chart here going back to first quarter of 2010 that has the postpaid. It's basically just the upgrade rate for the iPhone for all the three big carriers in the United States, AT&T, T-Mobile, and Verizon. Essentially, started about 9% in 2010. So that's the upgrade rate each year. And it has fallen, I think, well, what would you say? That's about 3.5%, something like that. 3.5%. And it's been fairly linear for the last 15 years.
What do you think this stems from? Just like longer upgrade cycles because the phones are getting better, or?
Yeah, there's just the improvements aren't that much. They've solved the problem of the phone.
Okay. Yeah, I mean, it's more and more the revenue seems to be coming from services as not only at first it seemed like that was the opportunity, but now if you have longer upgrade cycles, it maybe seems like they have to generate more and more revenue from the services business too.
Yeah, my question is whether this bottoms. That's a huge question. It doesn't show any signs of doing that. Now, there's a little bump during the pandemic, probably just can be explained by the stimmies, but I wonder if this ever bottoms because I see no reason why it wouldn't. They do the battery upgrade things. Can you tell the difference between the last 5? And so far, it hasn't hurt the stock. I'd say it probably has hurt the business because we haven't seen revenue. It's been stagnating for a while now. TBD when it hurts the stock.
Yeah, there really has not been a time where I have felt like I wanted to upgrade my phone because of a really awesome feature that was launched on a new phone. Like my significant other literally a week ago went and got like the newest version because she had to. It doesn't seem that different than mine. The only time I'm going to upgrade is when I absolutely have to because my phone's no longer working or it's, for
a $100 battery upgrade. Keep that right in the back of your head.
Really?
I'll do that for you.
I did not know that.
I think it's because they got caught.
You're ruining their business, Brett.
Yeah, no, I think that they've been forced. They may have been forced to offer this, or they did this to not get in trouble with those. Remember the conspiracy theories about how they lowered the battery life? That was proven to be true. So
I do remember that.
Yeah. Sometimes that's a fun conspiracy. No one gets in trouble over that, except for Apple. But all right, let's get to your listicles. What do you got for us?
Yeah, I'll go quickly through these because most of them, frankly, just don't interest me, but could be wrong here. Maybe these all end up being good, but 7 industry leaders at new 52-week lows. So just looked through the 52-week lows list, found companies that I consider industry leaders. And maybe it's just like they're just big companies for the most part. But number 1, Chevron, they're a leader, I guess, in upstream and downstream production of crude oil. Trades at 11 times forward earnings. I'll just right off the bat here say I'm not really interested. Commodities are kind of outside my circle of competence. I'm going to just ignore it.
Buff Dog likes it, though.
Yeah, I'm just not the buff dog. He probably is He is for sure a lot better at analyzing these things than I am. So, yeah, it's just not going to happen for me. Number 2, Boeing, obviously a leader in aerospace design and manufacturing, kind of run that duopoly with Airbus. 122 times forward earnings. Obviously, they're under. Well, I say
Market
they're
cap,
they're
yeah.
under earning purely based on the fact that they uh, they have been having production issues, so they haven't been able to fulfill all the demand that they have.
I mean, the market cap's $100 billion, I believe. I'm going to confirm this right now on FinChat, maybe share a quick chart. I believe they've done over $10 billion in free cash flow a year. So
Is there a price you'd buy this at? This is a local business for us. It's one that employs a lot of people in the state of Washington. That's where we're from.
Support your local businesses, Ryan. I don't know. I think if I get no updates on management, I get no changes in my opinion on management and the management culture that has been the 21st century Boeing, no. But if we get any indications that that's going to change or has changed, maybe. I mean, it's a very wide moat business. Let me share the screen. Show you this free cash flow chart. What are your thoughts? Would you buy it?
I don't think so. Also, it's worth mentioning that the enterprise value has changed. Like the net debt has changed a lot, even though the market cap has come down quite a bit. The net debt is certainly different because they had to take on a ton of debt to get through some of the issues they had. The other thing that I think is important to keep in mind, everything's going to be a little slower now. The FAA's, I think it's the FAA, right? Their involvement and the check boxes and having kind of the regulators over your shoulder slows a lot of things down. Maybe, and that might be for the best, but every little decision, it's going to take a little bit longer. So ramping up to production, I suspect it's going to continuously take longer than management projects, and it already has.
Yeah, and you would have even said before the FAA is it too harsh to say bought by Boeing when they just staffed ex-employers there? You could argue that they were moving quite slow and haven't really innovated much besides the 787 that was delayed multiple years and way over budget. So, yeah, not great.
I don't love it. I think they're going to
Next one. This one's spicy though. This one feels
Sure.
like close your eyes and buy.
All right. Number 3 is Intel. They are still a leader, market share leader in CPU production globally. Trades at forward PE of 53 times. I have not really looked into Intel that much, but it seems like one of the most hotly debated stocks out there because everyone's like, no, they're no longer innovative. Then other people are like, yeah, but they are still a leader. So where do you sit? You're more of our chief engineer, the chief Chit Chat Stocks engineer. Where do you sit on this one?
Yeah, I will say I do maybe know a little bit more than Ryan about the semiconductor market, but I would not say I'm an expert analyst whatsoever. I'm going to show you this chart. This might surprise you because we're supposedly in a semiconductor boom right now, but I think this shows that it's really only a boom if you're tied to AI, and Intel's been losing in that. Check out this revenue. 2021, basically $80 billion, $79 billion. Last 12 months, $55 billion, Ryan. I'm going to show you the free cash flow too.
That'd be a bit concerning.
Yeah. Now, oops. Let me click that. Free cash flow.
There we go.
Is it, well, unsurprisingly, negative. Now, you could look at this and say
the facilities.
Yeah, they're building it. Yeah, I heard one person argue in my mentions that they're building out a lot of manufacturing, but if you look at that revenue line item and you say, well, they're increasing supply greatly, and then everyone just still sticks with TSMC and Samsung, well, that could be really, really bad news. But on the one point, you could argue here, look, December 2020, $21 billion in free cash flow. Basically, all 6 years before that, over $10 billion in free cash flow. We're at a market cap of, I think, $100 billion, $80 billion. EV 110.
But
See,
did you see the CEO was praying on Twitter after?
yeah. Let him do his thing. It's fine.
No, I
It's
know.
fine.
I saw someone like stock dropped after I think the most recent quarter, and I saw someone's like, "I'm new to investing. Is it bad that you to have your CEO praying?"
He does no, he likes to post that type of stuff. I follow him.
Yeah.
He that's not abnormal. He does it all the time. Kind of like a Russell Wilson for which might not be a good thing. But
Anyway, all right. So
I think I don't know that one. The U.S. government isn't going to let the business die because they've basically said they won't.
true.
But does that mean the stock does well? I don't think that has to match up.
Okay, number 4 here, Stellantis. They are a leading automotive manufacturer globally. They're home to brands like Dodge, Jeep, Fiat, Chrysler, and a lot more. Get this. Forward earnings multiple is 3 times. Any interest?
No.
Why?
Just put automotive in the apparel category. Just
Yeah, I
you'll
think
be
those
better off not to buy any of the stocks, no matter how cheap they look.
Yeah, I think the earnings multiples. The forward earnings is I feel like it can vary quite widely, and analysts can easily be wrong with automotive since there's so much costs involved. Number 5, Estee Lauder. They are a leader in the cosmetic space. They're home to brands like Clinique, Aveda, Estee Lauder itself. 29 times forward earnings.
Really?
Yeah, I think they might have had a lot of these companies have had deterioration in their earnings or their margins.
Okay,
So
right. Yeah.
it
Low
like
cycle earnings, something like that. I like these type of businesses. Don't necessarily love them. They seem to be long lasting brands. The only holdup is you got a big exposure to China. I
true.
don't know how much predictive power I have about that market.
All right. Number 6, Dollar General. They are the largest dollar store operator in the United States. They have had a lot of pressure on their customers recently, which has forced them to drop prices. And quote, I love when they say, we are focused on providing more value to our customers in terms of our price points. It's like you are dropping prices because you have to. And
Your margins
which
are going down. I'm going to bring up that operating margin chart and share
Yeah,
it for you.
I mean, operating margins, I think, have been cut in half, so it's been difficult for them. Although forward earnings multiple 13.6 times. This one I find honestly fairly interesting.
What interests you about it?
The sentiment on it, like everyone seems to. First of all, forward earnings multiple 13.6 times. Earnings margins have been hurt in a big way. If there's any room for them to get back to where they were at, which maybe it's maybe this is this new steady state of things. I think they're in a good spot. I mean, it's Dollar General still drives a lot of value to their customers. They're in a lot of the rural areas where there aren't that many competing stores, and it's sometimes a quick stop for a family that really needs it. So yeah, you can see their margins have been basically cut in half. Um, I think there's still some value in the brand. Tons of stores. Obviously, the operating performance hasn't been great, but
What about the Temu alt data?
I don't care about the Temu. I
Well,
really doubt the family of 5 in rural Arkansas is buying their groceries off Temu.
yeah, I would say definitely groceries, maybe not knickknacks. On the one hand, yes, there's no way Temu can make a profit selling to rural America with their business model. But on the other hand, do they care? And how long can they run like this? Yeah, I mean, operating margin was 8%. Let's say that's normalized. Say that's fine, especially as they have more, as you mentioned, improving that durable goods, the groceries, the daily items that have a little bit lower margin. Today we're at 5%.
There's
And
been a lot of inventory markdowns as well.
yeah, so if
So
it reverts back up, I mean, you don't even need that much growth in the stock. The stock's going to work.
yeah. All right, let's keep flying through this because I do want to get to our small cap of the week as well. Because I think it'll pique your interest specifically. Number 7, though, last one here. Topgolf Callaway. I believe they're down more than 70% from their highs. They
I
are,
used to be bullish on this one, huh?
yeah, they are,
Luckily, it remained on the watch list. I almost bought it.
yeah.
Dangerous.
Now, this is a company that I think has been somehow trading at an EBITDA or an adjusted EBITDA multiple in the single digits for like 4 years, and it's never materialized. The, the cash flow doesn't seem to be there. However, the apparel business is bleh, it's fine. Equipment business, bleh, fine. I think Topgolf, I think it's still going to be a good business. And even though the performance hasn't been wonderful, and there's been some dip in venue spending, if I'm not mistaken, especially with big groups, I still think it's going to be a fine business. I could be wrong on that, but I think the Top Tracer bays, those got to be profitable when they sell to driving ranges. They, it's idiosyncratic. It's very unique. I think not a ton of competition. So I don't know. I maybe I have to do a ton more work. I don't like Chip Brewer, the CFO or the CEO, sorry, but still interesting. Down
Yeah.
75%.
Yeah, looking back, it's something we both followed this since 2021 again, luckily, remained on the watch list. The CEO and the management team definitely misled. And I think a red flag should have been the fact that they were making mobile video games. I think
Yeah.
that looking back on that should have been, maybe they don't have the eye on the ball for return on invested capital here.
They are trading for less than they bought Topgolf for, the
Really?
consolidated business.
Yeah, I
I
mean, I
believe
saw
so.
those numbers. It's ugly stuff. This is another plug your nose, and somehow it works out. Everyone hates this right now. Maybe it works. My highest, I know you're gonna ask, what one's your favorite? I know everyone hates it, but Intel, it feels like if it works, they're gonna be as big as TSMC in like 10, 15, 20 years. But there's also a chance that it's a zero, so it's not the way I invest. And the second one, I was shocked that Dollar General was at, I saw it at below $80 a share there. That's quite cheap.
Yeah, both Dollar Tree and Dollar General are down more than 70%, I believe, from highs. So both those were considered durable compounders for a while. Anyway, still running up on time here. So I'm going to go ahead and talk about my small cap of the week, which people seem to be liking this segment. So we appreciate that commentary because it helps give us direction for future small caps or future segment launches as well.
Yeah, and before you do, I want to make sure we talk about one of our sponsors that everyone's well aware of. We just shared the charts, finchat.io, all those charts, interactive tools, and Ryan mentioned AI Copilot. That is very useful for your investing research. Check it out, finchat.io/chitchat. Link in the show notes. Just wanted to make sure we got that in there before time's up.
Yep.
Oh, we got a comment that says Intel will be a small cap of the week within a year or so.
Maybe.
Yeah, maybe we'll that's when it's finally a buy.
All right. Well, this small cap of the week, which is presented by, I'm going to start doing that now. Small cap of the week presented by Yellow Brick Investing, which actually, if you go ahead and search this ticker, you can find a really high quality write up on there. Grocery outlet bargain market. It's popular in our corner of the United States.
Can you hear the advertisement in your head right now? The little
Yes,
jingle? Yeah.
they got a great jingle. We had success investing in Sprouts Farmers Market, kind of a smaller grocer as well. The kind of one-liner here is that Grocery Outlet is a discount grocer. They operate just under 500 stores in the US, and they offer items for super, super cheap. Here's how they keep their prices low, according to their website. It says, step one, when a brand has excess inventory from packaging changes or manufacturing overruns, they call us. We buy these excess products for pennies on the dollar, passing the savings on to you. Basically, they get a whole bunch of the excess inventory. It really is kind of a marketplace layout. Like it's not the prettiest grocery store you'll ever walk into, but you'll notice that all the prices on everything is like incredibly cheap. And then from the write-up on Yellow Brick, it says, at the store level, the company operates on a franchise model with each store independently owned and operated by local entrepreneurs. This decentralized approach fosters a strong sense of community involvement and personalized customer service. That makes a lot of sense to me. If you're operating in a different area. Like this is not something you want like all the inventory to be the same. You want localized buying based on the customer preferences. It says the independent operators initially contribute capital to establish their business and share store level gross profits with the parent company. So sort of a franchise. It's a franchising model. It says grocery outlet has meaningful white space for geographic expansion with visibility to 10 plus years of strong store growth ahead. Revenue growth has been really strong at this business, basically 12% CAGR since 2016. You can see they're really popular on the West Coast. They've got a couple stores on the Northeast, a lot in Pennsylvania. I don't know. Any interest here? So I guess
Definitely.
there isn't not a capital returns story here. The earnings multiple isn't that cheap. They trade at a $1.9 billion roughly enterprise value. And at the peak, they were earning about $100 million, I think, a year or two ago.
Yeah, I'll maybe share the chart. I had it loaded up. What do you know why operating income has been a bit cyclical? Is that just kind of COVID dynamics, the stuff that's hit a lot of these retailers?
Not sure. I'm really not sure. I remember them saying that there was a huge like tech systems change. I can't remember that cost them like $33 million to implement. Maybe it was like a
Uh-oh.
CRM or something.
Oh, yeah, the SAP implementation.
Yeah. If it's like a point of sales or a checkout process, that's the kind of thing I think that can actually generate good returns on investment. Like if you're building
Yeah.
that out.
Some of these businesses just have terrible. But yeah, look, hey, last 12 months, $83 million in operating income. If you think that's a short-term blip, could be cheap. Let's try to learn from our Peter Lynch episode. Have they talked about whoops, hopefully my screen went blank, but I think I'm probably still loaded there. Have they talked about the returns and traffic and whatever of stores that have gone on the East Coast versus the West Coast? Because if they've proven that, then we could have a nice runway for growth story.
I haven't looked into it enough. I know a lot of the bears here talked about concerns that the new stores were struggling, but in that write-up on Yellow Brick, it kind of it refuted that a bit. Basically, like the independent operators can ask for loans from like working capital loans from grocery outlet, like the corporate side. And they said it was like a whole bunch of the new stores were really struggling. They were asking for more working capital loans, but whoever the author was here said it's well below their historical average in terms of loans per facility. So it seems like maybe that's misleading. I don't know. I'd be curious how some of those stores are doing. The only thing is these aren't landmark facilities. It's not like you get a bunch of local news like, whoa, look how well Grocery Outlet's doing. Like it's just your local discount grocer.
Exactly. Almost a Dollar General type thing. And you're going to have, a store that's been 10 years in California is not going to have, it's going to have way more volume than a store that's just opened in Pennsylvania. But if they can prove similar returns on invested capital, and I'm not sure what if they own the stores or whatever the model is, if they can prove similar things for Pennsylvania versus California, especially if it's even rural versus urban or whatever the strategy is, and they only have this many stores, hey, that's, again, people love Grocery Outlet in Washington. It's a good option when you're looking for some cheap groceries. And hey, I'm guessing they benefit from a recession. So if you're right, as our macroeconomist economist in chief, or who knows whether we're in a recession, but it could happen. That could help.
They had double-digit comp sales in 08 and 09. So yes, I do think this is one that's kind of
100%
counter-cyclical. They've got. I remember the first time I walked in there, and this doesn't really matter for the investment thesis, but I thought this store looks pretty ugly. The items are not like the best items in the world. And then you see the price tag and you're like, wow, okay, this actually isn't bad at all. Like unbelievable prices, honestly. So, and I think low prices tend to translate everywhere. Maybe not like the super affluent areas, but
yeah, Manhattan. Maybe not Manhattan.
Yeah, other areas, I think great prices translate all over.
Yeah, exactly. And I'm already trying to formulate any sort of competitive advantage thoughts if they run this model where it's almost based off of the excess inventory from everyone else. Well, then a flagship retailer like a Walmart or Amazon, you can't compete with that.
Yeah, I wonder who their suppliers are, and maybe that like restricts the geographic expansion depending on if it's like local suppliers versus like the big chains kind of thing. If it's big chains, I don't see why they can't provide customer value and good price points everywhere. So I would suspect, yeah, curious to see how this geographic expansion goes. But small cap of the week, I think market cap. Give me a sec. Ticker GO.
Yeah, I'm gonna do the market cap, EV check, shares outstanding check, margins check.
Market cap is like 1.7 billion, and my new small cap of the week cutoff is going to be $2 billion. So if you have any ideas, that's my cutoff.
All right. Maybe we can call it. I know we've used this term before. We can call them the not so small cap if you find something that's over $2 billion. But no, I think there's thousands under 2 billion. So we'll have plenty of inventory.
Yeah. So small cap of the week, grocery outlet, bargain market, future small cap of the week, Intel.
Yeah, that's going to be in another year once TSMC ladders them yet again. Do you think grocery outlet should be your next stock research episode?
Potentially.
I'm doing Celsius.
That I know we're going long here, but that other small cap of the week I did like 2 weeks ago, the one with the like wild insider buying, did some digging. That management team is competent. They're good.
Nice.
They passed the gut check. So
they're probably good. We never be 100% certain.
Yeah. Sorry, they feel good. The CEO seems very passionate about the product. He's got an investment banking background, so he seems to understand the capital allocation side of things. I don't know. There's a lot of good vibes coming out of there.
All right. Well, that could be one too. Yeah. I think if you don't do grocery outlet, I'm doing Celsius next, which looks very fun. Stocks tanking could be hey. Then after that, I'll probably do grocery outlet as a little tease as we wrap things up here. Just released as we're recording this, an episode with Travis Hoyam from Asymmetric Investing on EVs, electric vehicles, Rivian, Tesla, China Supply, BYD, plug-in hybrids, a lot of stuff. I said something along a clickbait title of why most EV stocks are doomed to fail. So, hey, check that out. I think it was really good analysis. He follows the automotive sector in general quite well. Next week, we're going to have an interview with Simon Erickson on Rocket Lab, which I think is one of the most fascinating and maybe one of the only legitimate hyper-growth tech stocks in the innovative, all those sectors that kind of have a lot of mumbo jumbo. This one is actually executing, I think, is a fascinating company. And I think that's kind of the slate we got for a lot of research. So, yeah. Oh, we had also one comment that our mics were off. We did notice that post-production last time. There was an update on Microsoft on my end that reverted the settings. So we apologize. Didn't catch that, but hopefully we have a little checker thing that will make things more even from here on out. All right, let's hit the disclosure. We are not financial advisors. Anything we say on this show is not formal advice or recommendation. Ryan, I, or any podcast guest may hold securities discussed in this podcast, may have held them in the past, and may buy, sell, and hold them in the future. Thank you, everyone, for tuning in. We go live Wednesdays, 1:30 p.m. Eastern Time on the YouTube page. You can join us then. If not, listen on your podcast player of choice, and we'll see you next week.